Many of you will have heard of PayPal, now a household name in a FinTech context. They are responsible for developing the original digital wallet. Ironically, in the early days, PayPal patented technology, the bits that worked that is, from a failed electronic cash system from the mid-90s. Owners of a PayPal digital wallet can transfer money from their bank account into the digital wallet account, after which transactions can take place between them and other wallet holders, including merchants, without money actually changing hands. A single line of code on a PayPal server executes to establish the fact that the virtual balance of, say, £100 that used to belong to the payer now belongs to the payee. PayPal's operation piggybacks on the existing banking payment system and could not function without it. However, operations are completely decoupled from the banking system once money is transferred into the digital wallet and for as long as the balance remains within the wallet. Of course, the owner of the digital wallet can withdraw their balance back into their bank account at any time. Within the wallet system, virtual money is transferred in real time, in other words instantly, and free of charge for most users. A free service for consumers paid for through a fee-based business model for merchants. Digital wallet transfers are facilitated by more user-friendly identifiers such as mobile numbers or email addresses instead of needing to use branch sort codes and account numbers. The technological aspects are surprisingly simple. Again, it is helpful to represent this process using the five-party diagram with the sender and the receiver, or more formally the payer and the payee respectively, their banks and the conventional payments rails operated by the banking sector. Now, let's give PayPal accounts to both the payer and the payee, which will be linked to their respective mobile numbers. In this case, we are going to need another bank account, one for PayPal. This bank account will serve as a central conduit for money flow in the system. Note that PayPal, like most other digital wallets, is not a bank. They don't want the increased regulation associated with becoming and operating as a bank. This being the case, in order to be able to legally hold your money, PayPal has to first partner with a bank and set up an account there. Now, to put money into the wallet, say £100, the PayPal app first authenticates the user and the request, which can easily be done biometrically. This initiates an ACS pull transaction that transfers £100 from the sender's bank account into PayPal's bank account. ACS stands for the Automated Clearing System, which is an umbrella term we shall use to collectively represent the existing payment systems in the UK. Now, although this is PayPal's bank account, they cannot touch the money in it, for instance to invest it. It simply holds that £100 as a custodian on behalf of the sender. That amount will be linked to the sender's PayPal account, showing up as a £100 virtual balance in the wallet. If we pause and briefly review the steps here. So far, money has moved along the existing payments rails, but now that it is in the PayPal's bank account and designated to the payer, the information flow, which is now in the form of virtual money balances within PayPal, is decoupled from the traditional ACS. If, for instance, the payer wants to send the £100 to another PayPal user, they simply put in the payee's identifier, the linked email address or phone number, and the virtual balance can be transferred instantly. On the back end, PayPal does not actually have to move any money. A single line of code in the software will reassign this £100 from the payer to the payee. The payee can keep that virtual balance in their digital wallet and use it to pay for something or send it to someone else, and the code-based wallet reassignment process will repeat. Or they can decide to withdraw the balance from their PayPal digital wallet, converting the virtual money back into real money in their bank account. The withdrawal process occurs again along standard ACS payments rails, from PayPal's bank account to the receiver's bank account. Settlement, depending on some ACS specifics, may be same day or next working day. This example helps us see the key distinguishing features of digital wallets. Money flows on the traditional payment rails as usual. Banks in this setting are doing what they're best at, moving money from one account to another efficiently and securely. Information flow, on the other hand, is decoupled from the traditional rails and predominantly managed within the digital wallet application. As long as they're within the wallet's ecosystem, virtual balances can be moved around instantly and freely and used just as money. This innovation enables the digital wallet provider to facilitate economic transactions without becoming a bank. The tech innovators are doing precisely what they do best, taking on tasks like information processing and basic authentication from the banks. Rather than attempting to revamp the entire payments rail, it is much easier to improve the efficiency of these processes with incremental technology. In many regards, the digital wallet characterizes the payment systems of today. Here we have finance and technology.